Hello, it's Bill Rayman. I want to address one of the most perplexing and most misunderstood aspects of getting a loan, and that is locking. Locking a rate. As you can imagine, I'm sure you, like everyone else, is constantly asking, what's the rate today? What's it going to be tomorrow? Should I lock today? When do I lock it in? Locking is a systematic procedure wherein either the bank or broker says to a lender, for a very specific transaction, for this individual, for this property, I want to set aside this amount of money on this particular loan program at this interest rate for this amount of time. Here's the interest rate, lock it. To lock, I need to have, at minimum, an application which gives me some basic information about you that says you're looking to get a loan. Once I have the application, I can open and register a loan. Now I have something that can be locked. So it's a continual dilemma when to lock. Let's say you've got the purchase contract. Let's say you know you want to refinance. You start the procedure. It is, I think, the most complex aspect of doing a loan because you control when to choose to lock. There's a risk-reward feature that banks operate on, and it affects locks. The longer the time period that you ask a bank to guarantee a rate, the more that bank is at risk that rates will change, the more expensive that lock will become, either in terms of the interest rate they'll charge or in terms of fees they will charge you for that interest rate. Conversely, the shorter the period, the less the risk, the less the cost or the lower the rate you can get. An example would be you went into purchase contract today in a house, you've got 45 days to close escrow. You need to close the sale. You do not have to lock the rate today. You don't have to lock the rate tomorrow. You have, or at least the way our company functions, you have from today until roughly 10 days before the loan closes, because we need some time to actually print the documents, get through the last procedures, and get them out. You could lock that rate any time during those 35 days, and 35 in that specific example of 45 less 10. The earlier you lock the rate, the more you know you have something secure, and you can get on with your other facets of the purchase, which are not uncomplicated. If you locked it for 45 days, because you have to lock through the period that the loan actually funds, you're going to have a certain cost. Now, if you believe that interest rates are going to decrease or even remain flat for the next month, you would be better not locking now, because if you waited 30 days, you're going to get either a lower rate or you'll get that same rate, but it will cost you less in fees. There's no way of knowing, because the gamble would be if you opted to wait and the rates go up, because the market determines the rates, not the broker, not the bank. I mean, the bank, yes, but they're responding to the market. Particularly if it's a purchase, you have to close the loan or you risk losing your down payment. And if the rates go up and then you have to lock, you could be locking at a higher interest rate than you originally thought. A worse predicament could be if the interest rates go up enough that your payments go up. We've had situations where the person no longer qualifies for the loan, so it's something to be aware of. Now, locking is both a protection for you and a protection for the bank. They need to plan their business. They need to plan their capital funds. Well, the fact that it's a protection for the bank, you can be pretty sure that means it's not necessarily good for you. And the reason is, let's say interest rates go up from the time you lock to the time you close. You will feel great that you locked at a lower rate, and the bank absorbs it. They're okay with that. They can't come back to you and say, well, we didn't really want to do that. We want more money from you. Well, the converse is true. If from the time you lock, the rates drop a little bit, the bank is not going to say, yeah, we're going to be generous and give you that money back. They took the risk also. So locking both protects you, but it will generally prevent you from taking advantage of small dips in the market that might happen afterward. You're never going to know where the nadir, meaning the lowest point of the market is. Home prices, you're never going to know when the lowest price of that home is going to be. So you're trying to find a rate that you're comfortable with, that works for you. My advice generally is, if that's the case, lock it, be done, put your mind on other things, because otherwise I've seen people spend every hour of every day until the deal closes worrying about what's going to happen with the rates. It's not a fun thing to go through. I will get you as much information daily so you can make your determination on when to do it, and then you're locked in.